So first, let's talk about interest rates and bonds and why what happened to SVB is so important to just regular investors. First, remember this: bonds have an inverse relationship to interest rates. So when the cost of borrowing money rises, or i.e., interest rates rise, bond prices typically fall, and then of course vice versa, right? Most bonds are going to pay a fixed interest rate that typically is going to become a little more attractive if interest rates fall, which typically drives up demand in the price of the bond. Conversely, if interest rates rise, interest investors are no longer going to prefer a lower fixed interest rate paid by a bond, and that's going to result in a decline in the price. It's something that's so simple, but even I've been doing this for many years. It still sometimes gets kind of convoluted in my brain. Just think of it this way: if you had two identical offers, say, let's say a municipal bond from one city or for a city, one of the bonds is paying 7% interest, the other bond's paying 3% interest. Which bond are you going to pay money for, right? So it kind of comes down to that basic principle. These are the basics of how bond prices fall when interest rates rise. There's more demand for the higher priced newer bonds. And with higher demand, you get higher prices. At least that's what I learned through my economics degree at the Harvard of the Midwest, Missouri State University. So what happened with SVB? We're going to touch more on this later in the episode, more in depth. But basically what SVB did was lock in a tremendous amount of money, 80 billion worth apparently, into long-term bonds, particularly from what I've read, 10 plus year maturity mortgage securities, mortgage bonds. And then of course, what happened is SVB got smashed by rising interest rates. The bank's cash balance, the reason there was so much in these long-term securities is apparently SVB had taken in a tremendous amount of deposits over the last handful of years from the tech industry, and they simply didn't have enough places to make to loan the money out. So they placed these things in long-term bonds, and really what came down to is they made a bad bet. Again, as we'll go into more detail later in this episode, they made a bad bet on interest rates. They got locked into something that, if they'd had time to play it out, if there had never been a liquidity event, pretty good chance they'd have been fine. Problem is, they had a bank run that basically they was required more cash coming out than they had on hand because banks do not keep all their cash available, and consequently, they were in a position where they had to sell some of these underwater bonds, if you will, or bonds that had lost value anyway. And that spooked. It became a vicious cycle. And next thing you know, we've got a bank run, and bye bye Silicon Valley Bank. Signature Bank appears to have made some of the same mistakes. I think it was, but for everything I've read, it was compounded. To be fair to the listeners, I kind of heard of Silicon Valley Bank before, just because we do some things related to tech. Never had heard of Signature Bank out of New York. I guess it was based or started in New York City. And the funny thing is, I think that Signature Bank, based on New York City, actually had a little bit more involvement with cryptocurrency, which apparently was part of the reason that there was a bank run. And the reason I say it's surprising, because you would think Silicon Valley Bank, which is based in very tech-heavy California, Silicon Valley, San Francisco, all that, you think that they would be the ones that would be a little more aggressive. But by all appearances, it wasn't aggressiveness that brought down SVB. It was more just a really bad bet and poor management on paying attention to interest rates and how they're locking up their excess funds. Where Signature Bank, again, it appears that they maybe had made some of the same mistakes, but I think they were more brought down by their involvement with New York-based real estate. In fact, I read, whereas the tech guys, the hedge funds and things like that out in Silicon Valley are the ones that kind of accelerated the bringing down the bank, bringing down SVB. It looks like the pooling of funds by real estate investors out of the New York area-ish were part of a significant reason why Signature Bank went down. So that's kind of the basic reasons. Let's talk about the fundamental things behind all that. First, why did those interest rates rise? Well, they rose because the Federal Reserve decided to raise the Fed funds rate. For those of you all that are not familiar with that, I know you've heard of it loosely. It's basically the rate at which commercial banks borrow and lend their excess reserves to each other overnight. It's not something that actually translates directly to consumers, although, my opinion, almost any type of interest rate when it comes to banks, bonds, any of that, it's going to be based loosely or at least somewhat directly on the Fed fund rates. The Fed obviously did this to tame recent high inflation. Um, And here's where later in the episode you're going to hear co-host Michelle and I, or me anyway, pick on the Fed a little bit, and also pick on the FDIC a little bit. But why did the Fed Reserve? Why did we have high inflation? Here's my opinion, and I think it's pretty valid, and I don't think I'm the only one that shares this. The Fed kind of kept their Fed fund rates. Again, that's what a lot of things are based upon. They kept it artificially low over the past decade plus. One could argue that in 2008, we're coming out of a real estate crash, a housing crash, the economy is pretty banged up. That there was an argument to be made. Hey, let's get the rates low. Let's get this economy going again. Fine. You could also kind of make the argument that, hey, if we keep the cost of capital low, we're going to have all these investments in new industries, particularly tech, and everybody's going to win. There's going to be more employment. Fair, but there came a point where housing was back. Tech is blowing up. In fact, probably one could argue too much for easy money, cheap money. And instead of starting to, hey, let's start taking some cookies off the table here slowly, they just let it ride. And next thing you know, we've got ridiculously, anybody that lived through the late 70s, early 80s know that we could see a lot worse inflation than we've seen. But we've got a rapidly rising inflation. And in my opinion, that's a part of the problem is because they took their hand off the steering wheel. It's a lot of times, even though the Fed is supposed to be apolitical, you can kind of see some of the things they do based on how the political winds are blowing. So then tied into what we said in our opening statement on this segment, that all come down. Now we got volatility again. Good grief. I mean, how much volatility in the stock market have we had over the last couple of years? Because investors started getting concerned that regional banks, including some of their own regional banks, some of my clients called about a couple of various regional banks, were going to fail. And so what happens when you get that nervousness slash sometimes panic? You start seeing people sell. Typically, like in this situation, you saw people selling equities, which is one of the main drivers of your various indexes. That's why you saw a pretty significant correction earlier this week. And you also see a flight, they call it a flight to quality. Sometimes a flight to quality means they're just getting out of equities, getting into cash. Sometimes there's a flight to high quality bonds, which is kind of amazing, the circle of life here, if you will, because long-term bonds, particularly in SVB's case, were kind of the root of the panic. So there you go, one big circle, right? Just money just sloshing all over the place. So before we end our first segment, here's what I want to do. I want to pivot to an offer to our listeners today. And then also just to reiterate, I definitely think you stick around for segment 2 and segment 3. We're going to dive into the headlines related to these bank failures and how it relates to you all of those in or near retirement, and really, honestly, to any investor. And we're also going to have a little bit of fun, poking fun at some of at the government a little bit. We'll be fair with it in segment 3, where we talk about the things, some of the opinions I've had in the past. But before we do that, we're going to pivot. I recently did a comprehensive financial plan proposal for a business owner. He was looking to transition to retirement in his early 60s, had done a great job building his business, putting money away. Just one of the clients, if you're in my line of work as a financial advisor, you just love when people like this walk in the door. They've just got such a buttoned up life. It's really impressive. But this particular plan included using both a lot of specialized software as well as expertise and the experience of our team at Gulf Coast Financial Advisors. So I just wanted to share the kind of the basics of it, nothing particular on the client, just the basic plan outline, if you will. Now, I'll repeat this here in a minute, but if you're interested in having a conversation about working through a similar plan, be sure to give us a call at 251-327-2124. And of course, you can always email me at jnull. My first name is Josh, so J. My last name is Null, just like null and void, Null, at gulfcoastfa.com. So anyway, here's the basics of the plan. First, we're putting together a comprehensive financial plan utilizing eMoney, their financial planning software. We use that for the assembly, the presentation, ongoing adjustments, all the things related to this comprehensive financial plan, including sometimes if the client wishes, we can set up a digital central hub that keeps evergreen digital copies of our clients' most important documents. It's in a secure environment. Next, we're going to be doing some basic tax planning. I am not a tax expert. I'm not a CPA or accountant. However, my partner, the guy that works with me quite a bit in our practice, Will Stye, who is a financial advisor by trade, but has a CPA background. We're going to do some basic tax planning with his background and using a planning software called Holista Plan. And basically what that does is we're going to look at existing tax returns. We're going to see if we can identify any potential tax savings and anything available phasing in, phasing out to make forward-looking recommendations. We don't do tax preparation. That's for the CPAs and accountants of the world, but we do work hand in hand. A lot of times we'll use this holistic plan software to have a really neat and productive conversation with our clients and their their CPA team. Next, we're going to do a risk tolerance analysis using Riskalyze software. It's fairly well known in our industry, but I used to say it was an X-ray, but now that I know the software better, it's really more like an MRI. It's going to look at your current investment holdings and it's going to determine how those positions match up with your actual investment goals and your time horizon. And it's pretty cool. It looks at each individual holding and it really gives you a drilling down. And I'm going to tell you just from experience, it's pretty rare when someone comes in the door where their actual risk tolerance matches up with what they're actually holding. It's a really neat conversation, and it's a great way to come in and make some adjustments to get this thing back in line. And then lastly, we do a lot of income planning. We're going to do a customized income plan using a software called Retire Up. It's basically it uses portfolio data and actual modeling. And so the end result is a solution-based visual roadmap for your income planning. All this stuff's pretty cool. Yeah, I sound like a giant nerd, right, Michelle? But all this stuff is cool. It's really next level things, and it gives us the tools along with our own experience and expertise. I think that makes our offering fairly unique. Now, these strategies we design, they're used in part to help with income production as well as accounting for inflation and longevity risks. Not only are we trying to match your risk tolerance with your investment holdings, we want to help make sure you don't end up outliving your retirement savings. So again, if you're interested in having that conversation, give us a call, 251-327-2124, or you can find us at our website. That's Gulf, like the Gulf of Mexico, Coast, FA is in financialadvisor.com, gulfcoastfa.com. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance. And this past week was certainly an example of big news in finance. So every week, Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially articles that are going to pertain to those in or near retirement. So make sure you join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News of the Week segment. Stay tuned.